Tony Virtue speaking, Virtue and Partners, and happy Easter to you, what is effectively the end of the first quarter for the calendar year. A bit choppy last couple of weeks, and depending when you get to listen to this, it could be a good night or a bad night in Wall Street. So look, probably to be expected at this time of the cycle. There's been 10 years of really recovery. Much of the growth over there has been in these FANGs that I talked about, and Facebook got themselves in a bit of strife, releasing information to third parties that really pushed their share price down. And there's probably a wider issue here. Every time you jump online and put some information on Facebook or similar, you actually don't own that data. It's very valuable to advertisers, and the long and the short of it is I expect some tightening up of that law that will probably mean that those stock on balance are worth a little bit less. Trump also went out and followed through to some extent on these tariffs on China. That didn't make our day either. Look, at the end of the day, it's regretful, it's unproductive. You wonder how much of this is just browbeating and whether they'll just sort of sort something out behind the scenes. They all need each other. The net effect of that is that free trade is a better result for the community as a whole. As it stands, they seem to be kind of working something out behind the scenes there. But a combination of all of that and some fairly jittery fund managers meant that the markets for the quarter were fairly sluggish. That said, in Australia, the dividends are all held up, and many of you have received dividends in the last few days. So the actual income that's coming from the actual underlying shares hasn't changed. Domestically, the AAP have come out with a proposal to basically eliminate any excess franking credits back as a cheque from the ATO back to the public. This is quite a serious matter. As you can see from the graphs below, our top 6 stock paid dividends in that 6 to 8% range, and this is all franked up. Now, the people who would be hurt the most would be people who are self-funded retirees. They're not getting any benefits from the government. They're relying on these dividends, relying on these franking credits to fund their retirement. And in a perverse way, you're better to have a smaller level of assets and actually get a small government pension and retain those excess credits rather than be self-funded. So there's going to be a lot to talk about here. Look, it's a proposal at this stage. The reality is that we have a very strange Senate out there, and nobody knows where that will sit. So not to panic, but if this does become law, there will be changes in asset allocation, there'll be changes in how we organise people's affairs. It'll be counterproductive. Many of you have bought shares in good faith in your own name that have gone up substantially in value, and the last thing is the capital gains tax of being forced to sell them. So we're on top of this. There's a lot of lobbying going on, and we'll be in touch as this plays out. On the new IPO level, we are getting quite a lot of offers coming in at the moment. We do sub-underwrite here, so most IPOs come across my desk. We try and look at them very carefully as to whether that'll enhance your portfolio or detract, and who basically is really making money out of this. IPOs fall into really 2 main categories: stock-specific ones, where particularly private companies have done well, looking to list. Maybe the owners want to sell down some of their financial interests. These can be a little bit speculative. And then these, what we call listed investment companies, or LICs, who effectively buy shares in other companies. Not that dissimilar from a managed fund, but look, there are some good ones coming to market. We will be sub-underwriting, and where appropriate for you, we'll be in touch and pass them on to you if that suits your own needs there. Looking again, the property market seems to have stabilised a little bit here. Definite trend towards this urbanisation, trend towards easier living. You can probably build a new apartment a lot more efficiently than refurbing an older one. We're seeing in the client base people moving out of Sydney, expensive city now, one of the most expensive in the world, up to Queensland, and they'll fly down and see the kids as they need to there. So look, interest rates still pretty much at a 60-year low. A little bit more competition there between the banks. So again, don't get in over your head, but I certainly don't see a crash or anything of that nature in the property market, certainly here in Sydney. So look, that's enough. Happy Easter to you all, and I look forward to talking to you next month. Thank you, Tony.